Hey guys, Ryan Dement. I hope you're having a great day. Yesterday, the Fed came out just as expected and raised the Fed lending rate to 0.50 or increased it to 0.50. So yesterday when I shot my video, the 10-year Treasury note that is based on, we base everything off of for a mortgage, a 30-year mortgage specifically, was at 2.97. And then as of this morning, it's at 3.03. So a little bit of an increase, not the full amount because it was already baked in. But the one thing that I wanted to share is the Fed was asked a question about how they would bring everything neutral. And neutral means that when they raise the rates, it doesn't affect the economy up or down. They stay neutral, equal. And he came out and said, and I'm summarizing this, and I'll put a clip in the video. I'll be able to pull it out and do that. Is that their focus is to be able to stabilize the economy, make sure that we don't allow inflation to get out of control. And then in the same sentence, he says that they're starting to see where inflation is starting to stay at a level pace to where it's not increasing, but didn't want to give any more data on that. The moral of the story, or how we're going to get to this, is as soon as he started talking about they're not worried about inflation, the stock market took off, and it went over 1,000 points on the Dow yesterday, and I think it finished at 9 and some change yesterday. And then today, it's a huge sell-off because it was just it's just a big head fake is all it is. At the end of the day, there's a problem in the market, and it's called inflation. The Fed is slow to the trigger, and typically for you to curb inflation, and by no means I'm not a professional inflationist or a person that is going to say that I have schooling or experience in economies, but I can tell you just from basic experience, knowledge, practice, talking to people, that just because you raise the Fed rate by 50 basis points doesn't mean you're going to start curbing inflation. Typically, you have to get the Fed interest rate and also the Fed from buying and selling so much, I call it paper money, fake money, to where the Fed rate matches where the inflation rate is, because then you stop it in its tracks. And then the economy, unfortunately, is not going to have very much of a soft landing as he was talking about. It's going to be more of a hard landing or bumpy. They're behind the curve, and he already said in his statement and in the video I'll share with you is they are considering 50 basis point rate increases at the next two meetings already. They're on the table, which is already going to put us at 1.5% or 150 basis points in 3 meetings. More than likely, they're going to have to do that. What is that going to do to the market? It's going to take the market to the other side. It's going to start slowing down. And unfortunately, when they do this, it's a delayed reaction. We don't see the instant gratification like we do out of a lot of things. It basically takes some time for it to work into the system because the banks have to start raising their interest rates. They have to start looking at unsecured lines of credit, and do they start shutting them down on your credit cards or your personal loans or any other type of unsecured debt that has a fluctuating interest rate. So what I'm trying to get at, guys, one, the Fed keeps on raising the rates. It's going to happen. You need to be prepared because there's going to be impact in your wallet and my wallet. If you have credit card debt and you're carrying it, it's going to bite you. They're going to continue to raise rates for the time being. 2, if you're looking to buy a house, let this play out, because in the end, home builders, like I said in yesterday's video, will have to start lowering prices, 1, and 2, start offering incentives. Are those going to offset the increase in your interest rate on your mortgage? I don't know yet. but it's a good game to look at. It's a good thing to keep an eye on, and it'll be beneficial to you if you can actually find the right house with the right lender and the right builder that's giving you enough incentives to offset that. Because ultimately, you're talking 12 to 24 months of being able to do this, and then you'll be able to refi out once everything kind of calms down and we start going back down on interest rates. And you can see that history from prior years, like when we 2007, 2008. If you look at the ramp up of the Fed interest rate and then the ramp down, that was a little bit more dramatic, but it's still a good history lesson for us to learn from. So guys, be patient, work this out. But if you've got credit card debt, now's the time to start wiping it out, because your money is not going to go as far as you think it will. And this will start impacting it very quickly. I hope you guys have a great day. Stay safe, stay healthy, and I'll see you guys on the other side.